Today I'm going to be discussing profits interests. So what are profits interests? Well, for one thing, they are a way for a business that is treated as a partnership for tax purposes to issue equity compensation to service providers. Businesses that are treated as partnerships for tax purposes cannot issue incentive stock options, so this is an alternative that may actually have the same or better tax results for the holder. A basic definition of profits interests is that it is a share of future profits and appreciation, but none of the existing value of the partnership. So this means that if you receive a profits interest, that on the day you receive it, if the company were sold, you would not receive or be entitled to receive any distribution from the sale of the company. You're only entitled to a share of future profits and appreciation on existing assets of the company. As with all equity compensation, the purpose of profits interest is to attract and retain executives and key service providers for the company, as well as to align the interests of service providers with partners of the partnership. So one other benefit of issuing profits interest is that the original members retain their full value of the LLC or other partnership created prior to the grant of the profits interest. So who can issue profits interests? Well, any entity that is a partnership, like a general partnership, limited liability partnership, or a limited liability company that has not elected to be treated as a corporation for tax purposes. Most often you hear about profits interests in the context of LLCs. If your company is a single member LLC, you should keep in mind that if you issue a profits interest, you cannot be treated as a disregarded entity for tax purposes, for federal income tax purposes. Issuance of the profits interest automatically converts the disregarded entity into a partnership for tax purposes. This may have tax consequences in terms of a gain or loss recognition for the original owner. Now, there are two types of interests that a partnership may issue: capital interests and profits interests. A capital interest gives the owner the right to a share of proceeds if the partnership assets were sold at their fair market value and the proceeds were distributed in a complete liquidation of the partnership. As I mentioned earlier, a profits interest is only a right to receive a percentage of future profits, but not existing capital from the partnership. Profits interests are generally granted to service providers, whereas capital interests are generally issued to partners in exchange for cash or property contributions. One key note is that under current IRS guidance, the owner of a partnership interest cannot simultaneously be treated as an employee of the partnership. Therefore, if an employee is granted a partnership interest, either a capital interest or a profits interest, the employee becomes a new member or partner of the partnership. And as a result, withholding of employment taxes cannot be done at the partnership level. And instead, the new partner / former employee has to compute and remit quarterly estimated income tax payments. In addition, the employee would lose any entitlement to any employee-only benefits, such as a tax-free cafeteria plan or flexible spending account. In addition, the owner of a profits interest has whatever rights are provided by applicable state law to members of the partnership, including, in many cases, the right to inspect books and tax returns of the partnership. So that's another key point to keep in mind if you are considering, as a company, issuing profits interest to a service provider. Now, with respect to taxes, if structured properly, the contribution of a services to a partnership in exchange for a profits interest is a tax-free event for the service provider and to the partnership at the time of grant and as it vests. However, there are IRS guidelines that the company must comply with, as well as the holder, in order to ensure that the profits interest receives this favorable tax treatment. In terms of taxes, another key point to keep in mind for the holder is that the holder may be taxed on phantom income. So if the company has an illiquid asset that generates profits on paper, but there's not actual cash flow to make a distribution of profits to the holder of the profits interest, the holder of the profits interest may nonetheless be taxed on that phantom income and have to pay taxes when he or she never even received an actual distribution of profits. If you're issuing a profits interest, your company would likely want to impose a vesting schedule so that the service provider has an incentive to remain engaged with the company. Vesting can be based on the passage of time or the partnership's achievement of certain performance metrics or some combination of both. If you're a company and you are considering issuing profits interests, you will need to develop a profits interest plan and specific profits interest awards for service providers. And this would require consultation with an attorney as well as with a tax professional. If you're a service provider, you would also want to consult with an attorney to review and negotiate the company's offer because terms like vesting can be negotiated to be more favorable to your interests. So, in conclusion, if you're a company or a service provider, it would definitely benefit you to consult with an attorney. And I suggest that you click on the link down below to schedule an appointment with our office. And I thank you for watching.